Welcome, everyone. Today, we're breaking down a really important part of the new Income Tax Act 2025. This is something that could really change how you think about your clients' retirement savings. So, let's jump right in.
All right, let's kick things off with a situation that I'm sure many of you have come across. Imagine this. Your client's Provident Fund balance has gone up by $1 lakh this year. But here's the catch. They haven't touched a single rupee of it. So the question is that growth taxable? It's a great question, and it's exactly what the new act is designed to address.
Now, to really get to the bottom of that, we need to rewind a little bit. We have to understand the basic rules of the game. When does income actually become taxable? Because, it's not always as straightforward as seeing money pop up in a bank account.
Okay, so traditionally, in the world of tax, there are two main ways we look at income. The first one is the receipt basis. Super simple, right? You get the money, you get taxed on it. Think about your salary hitting your bank account. Then there's the accrual basis. This is a bit different. You're taxed when you earn the right to the money, even if you haven't been paid yet. A perfect example is when you send an invoice to a client.
But, and this is where it gets really interesting, what if the law just creates a third way? This is where we run into something called a legal fiction. It sounds a bit strange, but it's basically the law saying, hey, for tax purposes, we're going to pretend this thing has happened, even if it hasn't in the real world. It's an incredibly powerful concept. And this concept has a name. It's called deemed income. Think of it as a special tool the government uses to make sure certain amounts get taxed in a specific year. It's all about creating certainty and, well, making sure taxes are paid when they're supposed to be.
Yeah, a legal fast-forward button is a great way to put it. The law is basically hitting play and saying, look, we're considering this income as received right now, even if you haven't seen a penny of it. So why do they do this? Well, a couple of big reasons. It creates clarity and predictability. But just as importantly, it stops people from delaying their tax payments forever, especially when we're talking about big funds that just keep growing and growing.
And that, right there, is the perfect entry point for Section 7 of the new Income Tax Act. This is the section that lays out all the rules for these deemed receipt situations.
Okay, let's get into the nitty-gritty of Section 7. We're going to see exactly how this whole deeming thing works in the real world.
So, right off the bat, Section 7(1)(a) hits us with this key phrase, annual accretion. What it says is that the annual accretion in a recognized Provident Fund is, you guessed it, deemed to be received. And this right here, this is the core provision that answers that first question we asked about your client's PF growing by $1 lakh.
Okay, annual accretion. What is that? It's just a formal way of saying the total growth in the fund over the year. It's made up of two key things. One, the money your employer puts in, and two, the interest that's earned on the whole balance. And here's the clincher. The Act says a certain part of this growth, to the extent specified, is now considered the annual accretion for tax purposes.
All right, moving on to the next part, Clause B. This one deals with a different situation. It talks about the transferred balance in a Provident Fund. And yep, this is another case where income is deemed to be received.
So when does this apply? Well, it's for very specific scenarios. For example, say you have an unrecognized fund that suddenly gets official recognition. Or maybe an employee moves their money from an unrecognized fund over to a recognized one. In situations like that, the entire balance that gets transferred over could potentially be considered deemed income for that tax year. It's a big deal.
Okay, enough with the theory, right? Let's make this real. We're going to walk through a practical example to see exactly how Section 7 plays out.
For all you professionals watching, this is where it gets really practical. You're going to have to look closely at your client's PF statements and salary slips to spot these amounts.
So here we have a pretty standard, simplified PF statement for a given year. You can see the opening balance, you've got the employee's contribution, the employer's contribution, and the interest that's been added. It all adds up to that closing balance at the end.
Okay, now let's apply what we've learned from Section 7. We're zooming in on those two key parts of the annual accretion, the employer's contribution, that's $1,20,000, and the interest, which is $90,000. Now, the law says we have to look at the rules in the schedule, and based on those rules, a certain portion of this gets marked as taxable income.
And here's the result. Based on the limits set out in the law, for our example, let's say it works out to 15,000 rupees. That becomes the taxable deemed income. Now, this is the most important part. Even though your client hasn't touched that money, that 15,000 has to be added to their taxable income for the year. The exact math will always depend on the specific rules in the schedules, but the principle is the same.
Okay, so now that we know this rule exists, the next big question is, how do we handle it? What do we need to do to stay compliant and avoid any nasty surprises down the road?
I've got a quick checklist for all the pros out there. Number 1, always check the PF passbook against the Form 16. Make sure they match up. Number 2, you have to disclose this deemed income correctly in the income tax return. Don't forget that. Number 3, and this one is so important, talk to your clients about this, especially your clients who are high earners. They need to know. And finally, number 4, keep good records. You'll want to have those PF statements handy if any questions ever come up.
Before we wrap up, I want to address one common mistake, a real misconception that trips a lot of people up. Listen carefully to this, because it's absolutely crucial. The tax we're talking about under Section 7, the tax on the annual growth, is a yearly thing. It's totally 100% separate from the tax that might be due when someone actually retires and withdraws the entire amount. They are two different taxable events with two different sets of rules. Please don't get them confused.
All right, let's do a quick recap. I want to go over the key takeaways to make sure everything is crystal clear.
Okay, here are the big things to remember. 1, there are now 3 ways income can be taxed: receipt, accrual, and the big one, deemed. 2, Section 7 is your go-to guide for how deemed receipt works for provident funds. 3, annual accretion is that yearly growth that you need to calculate. 4, this income is taxed now, in the year it happens, not later when the money is withdrawn. And finally, number 5, understanding this isn't just a nice-to-have anymore. It's absolutely crucial for doing your job right and advising your clients properly.
I really hope this breakdown of Section 7 was helpful. Keeping up with these changes is what allows us to give our clients the best possible advice. Thanks so much for watching.
And just a quick disclaimer, this presentation is for educational purposes only. It is not professional advice. Tax laws can and do change, so please always consult with your professional advisor before you take any action.